These two choices have very, very, very different criteria for what defines a good trade. So you're going to have to pick one, and if you've done your homework, you've already made the decision. If not, stop trading and keep thinking about what you want until you get clear and make your decision. What up, my dudes and dudettes? I know that I say this a lot, but I've got some real game changers for you today. We're going to find out whether you've gotten clear enough to become consistently profitable. Like I've said time and time again, you need a strategy that is so specific and so simple that you can automate all of its aspects so you don't have to ask yourself a million questions when trying to trade, so that you don't have other strategies giving you conflicting advice. So today I'm asking you all of the most important questions and providing answers to each question as examples so you can see if you've really honed in on what your technical setup will be. If you take the time to accurately answer all of these questions, you'll be leagues closer to becoming a profitable day trader. All right, let's do it. The first and most important question you should start with when building your strategy is what makes a profitable day trader? Now, you may want to pause the video because a lot of these questions require a lot of thought. So if you want to test yourself out, then consider pausing the video now. All right. At its core, a day trader is profitable when he or she has a better risk to reward ratio than their accuracy. This means that a trader is profitable if they make more money on a winning trade than it costs that trader to have a winning trade. Just like if a business makes cars, those cars need to sell for more money than all the parts and expenses it took to make that car. And in day trading, it is no exception. Before you take another trade, really stop and think, how likely is it that that trade is going to make it to your profit target without hitting that stop loss? Because if that likelihood is, let's say, like 1 out of 10 or 1 out of 5 or 1 out of 4, or even 1 out of 3 of a chance that it's going to make it to your profit target, you're going to need that much of a reward just to break even. It's so important that you think of day trading in terms of probability, and it boils down to this profitable formula that is very simple. Basically, what that means is that when you take a trade, you need to determine how likely is it that it's going to get to your profit target without hitting your stop loss. Let's say it's a 25% chance. Now, with that chance, that means it's only going to be right 1 out of 4 times, which means you're going to need to hold that trade for at least 4 times as much profit as you risked just to make a decent sized profit. This is really going to help you think about whether or not it's a good trade to take next time you go to day trade or swing trade, because you're going to need to map out your actual profit target before you take these trades, and then you'll really see like how large is that profit target and how likely is it that it's actually going to get to that profit target. And when you actually look at that, that's really going to tell you, like, is this a good trade or is this extremely unlikely? Let me actually show you an example. Let's say that when the stock got to here, to this resistance level, that we were interested in shorting it. So let me zoom in here. When we come here and we decide that we're going to enter about here, the second high right here is a little risky and a little aggressive. So, I mean, you could have taken that trade or you could wait till here. But the point is, once you watch this resistance form again and be respected as it used to be back here, and we decide to enter that trade, we'll set our safe stop loss, so right about here at 48.40, and that's from an entry of about 48.25, which means we're risking about 15 pennies. We'll then want to start by seeing if it's possible to get to at least a 3R, because that's the kind of profit that I like to look for on my trades. So from here, if we did 15 pennies times 3 to get that 3 profit, we're going to get down about 45 cents. So 45 down from here is going to be about 47.80, which is going to be about this level right here. Then ask yourself, is it likely that we could get from here back down to here? And if so, do we have at least a 35% chance of getting there? Because if we do, then that means we'll make 3 times the profit for something that is likely to happen at least 1 out of 3 times, which means if we took this trade a million times, we would see that 1 out of 3 times we made, let's say, $3, and 2 of those 3 times we lost $1 because we risked $1. So that means that we will make at least 1 profit out of every 3 trades we take. So let me go through the math on that again. If we risk $1 and we hold out for a profit of at least $3, then every time we're right, we'll make $3, and every time we're wrong, we'll lose $1. And if we have a 35% likelihood of getting to that profit target, then that means that out of 3 trades, we will have won 1 trade for $3, and we will have lost 2 trades at $1 each, which will still leave us with $1, which is a profit of 1 R, or 1 risk. And as you can see in this trade, it ended up working out to the point where it went down to about 4 times our risk. So that would have been a 4 times winner. And now there's a lot more to trading than just, finding a simple setup and then holding out for 3R. That's a really good start. It's very mechanical. However, there is a lot more to increasing your edge and your accuracy and how much you win versus how much you lose. And those would be things like scaling in or honing into the market so that you have a better likelihood of knowing how the stock is going to move. And I cover that all in my other videos, but for now, let's get back to this. And now the next question to ask yourself is, what would a trade need to look like to get me a high reward and have a high probability of getting to that reward? The answer for this one is a little tricky because the larger you make your stop loss, the more likely you won't get stopped out, but the less likely you'll be to make a high reward in the trade, since the further the stop loss, the further each price target will need to be to make back 1R. For example, if you have a stop loss that's 10 pennies, I can make 10R if it moves $1 in my direction. However, if I have a 50-cent stop loss, I would need that stock to move at least $5 in my direction to make 10R. So to answer the question of how you can have a high risk to reward and a high probability, well, you can increase your risk to reward by only taking trades with small stop losses and holding most of the position until it gets to a high level of R, like 4R or even 6. Or you can also increase your risk to reward and accuracy by only scaling into winning trades. And the last piece of the puzzle is finding trade setups that are unlikely to hit a smaller stop loss and that are likely to run far in the direction of your price target. And this is why so many traders like price levels and trends, because both will have the smallest stop losses and the furthest room to run. Now, the next question you need to ask yourself is, how can I find stocks that won't hit a smaller stop loss and that will run in my direction all the way to a larger price target? Well, that's just the beginning, and that's exactly why it's so important to hone on such specific criteria where each one adds a small amount of accuracy to your trading style, and that's how you create your edge. What criteria can we get clear on and define to create an edge? The first thing you need to ask yourself is whether you want to swing trade or day trade. And no, you cannot pick both until you completely master one specific strategy. I'm telling you, these two choices have very, very, very different criteria for what defines a good trade. So you're going to have to pick one, and if you've done your homework, you've already made the decision. If not, stop trading and keep thinking about what you want until you get clear and make your decision. I'm so serious about this. If you don't know exactly what you trade, exactly what a chart should look like, the exact setup you want, how you're going to enter, where you're going to scale in, and what happens when it gets to your stop loss, you need to stop trading immediately and go back to the drawing board to get clear on what you're going to trade, what those stock setups are, how to scale in, how to manage risk, and what the technical strategy is. Because otherwise you're just going to keep wasting your time by trading randomly based off of intuition, and you're never going to be able to learn that way. That's just gambling. And now for an example, I'm going to start with day trading. So you'll also want to take it a step further by deciding which time frame you want to use. For day trading, I prefer the 5-minute time frame, but I'll also check in the 1 hour and the daily time frame just to find strong price levels before I take the trade on the 5-minute setup. For swing trades, I prefer the daily time frame and even the weekly time frame for stocks that I plan on holding for quite a while. Now, you'll need to ask yourself, what technical strategy are you using? And again, I can't stress this enough. Your technical strategy needs to be very, 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 very specific, because if it isn't, you're going to have a million different answers to every question going forward, which means that your strategy isn't specific enough. For example, if your strategy is trading price levels, well, are you trading breakouts or reversals? Because both of those require very different criteria. Reversals prefer a stock that's trading choppily in a large range and has no fundamental narrative or news that would cause a breakout rather than a reversal. Whereas a breakout trade more often occurs when there's a strong narrative and when the news comes out or is coming out soon. Breakouts also prefer a lot of momentum and a strong conviction, which is the opposite of a reversal. I could go on and on and on and on about the contradicting criteria of these two strategies. The point is, you need to pick one. You need to hone in on one technique until you become profitable. You cannot try to intuitively trade a bunch of contradicting strategies on different stocks, on different time frames, under different circumstances. That's like trying to run 50 different businesses all rolled into one store and then moving that store to a new country every day. And that's nonsense. Like, pick a lane. All right. You don't want to be a jack of all trades. Just get good at one simple technique. Because at the end of the day, you're going to be happy when you're making money, even if you're only good at one thing in the stock market. So for the sake of an example, I'm going to pick a breakout strategy, but know that you can take this a step further by making it a breakout toward a gap fill. The more specific, the better. So for example, we can see right here, this is what a breakout strategy would look like. So the market opened at about 30 minutes into the day. You could see it consolidated right here at support and then broke through. So this would be my entry at the bottom of the red. And then the top of the red is where my stop loss would be. We would want to hold for at least 3R typically. That's what I'll be doing. I'll go in more detail in my other videos on scaling in, on where I take profit and where I add into these positions. But for now, this is what like a simple breakout strategy would look like. But if we want to take it a step further to be a gap fill strategy, we would look at the same stock, but all I've done is I've turned off the extended hours time frame. So then now you can see that there's been this gap where at the end of the day, a couple days ago, it closed here and then it opened up here. So this has created this gap right here where there's no trading happening, at least during market hours. So a gap fill is when it breaks out to the downside, and we try to fill in this gap that was left during market hours and that was only filled in during after hours. So as you can see, there's this big gap and we are filling it. And that is a good example of adding more specific criteria to your strategy. That way you're going to get really, really accustomed to and really used to what the probabilities are of a trade like this succeeding and whether or not it's what you want to actually trade from now on. In fact, as you hone into doing this, just this one strategy, you'll be able to find out more and more what stock criteria makes a gap fill like this more likely to happen. And when you start doing that, that will help you get up to like that 40 or 50% or maybe even 60% probability of being right. And that way you'll be able to look for stocks that have large gaps that also meet your criteria that would lead to like a 60% probability. So then when you take those trades, you know you'll have about like a 50 to 60 probability chance and also getting 3, 4, or even 5R because you'll be looking for gap fills that have large gaps where you can take a risk to reward like this and hold out for even more. And now it's also very important to decide what kind of criteria can we find on a technical chart that would lead to a breakout trade that would have a low chance of hitting a tight stop loss and a high probability of hitting a large profit target. I mean, does that even exist? Of course it does. The stock market is infinitely huge. Remember, we live in a world where there are an infinite amount of possibilities, and that includes the stock market. Whatever you want and whatever you're looking for, I promise it exists. That's why it's so important in day trading and in life to hone in, get clear on what you want, and hold out for exactly what you're looking for because it does exist. So if we want a breakout that won't hit a tight stop loss and that will likely run to our profit target, then we're going to need a stock that isn't choppy because a choppy stock would require a larger stop loss. And we'd need a well-defined, clear, and obvious level to break out from, and preferably an overall trend would be in our favor. Believe it or not, that's pretty easy to find. All we would really need to look for is charts that are trending toward a very clear and obvious price level for a breakout without being overbought or oversold. And we'd want to make sure that the candlesticks haven't been choppy and erratic recently. Otherwise, we'll likely need a large stop loss, which is still acceptable if a stock can run for a really long ways. However, it's going to make it a lot harder to get a high reward ratio since you're going to have to use such a large stop loss. It would have to run for such a far distance to get to your profit target while still giving you like a 3 or more R. So for example, let me show you some stocks that are moving in the direction of the breakout and creating that trend so that we have that confluence of trades where it's going in the direction of the breakout that we're looking for and that aren't super choppy. And by the way, I literally did not handpick these stocks at all. These are what I've been trading for the past couple weeks. And on top of that, you can see these are the stocks that I use in all my videos as of recently because I've been recording for the last week. So now, as you can see here, we were getting some chop here. And then we got this breakout, and obviously as you get chopped like this, you'd have to use a large stop loss originally, which is fine. You can do that. Just know that you're going to need a large reward to risk to be able to make this an accurate and viable trade. And luckily, as you can see, going back up to the high of the day gives it a fair amount of room to run. So this is a viable trade, but another thing you could do is you could just wait for that breakout and then wait for like another pattern or a trend to form, which it definitely did. We got some consolidation and it did form this full trend. Or for another example, let me show you another pattern that had a breakout in the direction of the trend that would have been a viable trade. So we can see over here that we had this wedge and that it broke out to the upside. And as you know, there's also some resistance along the way. So, it's very subjective on whether you want to wait for that support to break, that resistance to break, or whether you're just going to enter as soon as the wedge breaks. The way to decide on that is if you can enter at the break of the wedge or whatever pattern it is, and you can use a small enough risk that makes sense that you can still get to that high profit target, then that's a viable trade and you could always take that. And then you could always enter more to your position upon the breakout of like additional resistance or at other breakouts. Or, if you don't feel comfortable, you could always just wait for the break of that other resistance and then just enter your first position there. But what I would normally do is if you're feeling like you've got some good risk to reward here, I would enter my first position on the original breakout. Or, if you want to play it a little safer, you could enter half of your risk or half of your position there originally and then enter the rest of it once it breaks out. So here we have the initial entry where it breaks out of this pattern, and then you could enter a second time right here, which I'll go over all these details in my other videos on scaling into a trade. But as you can see, the reason why this is a good setup is because we're trending upward already, and then we're also trading in the direction of the trend with the breakout. If this were to have broken to the downside, I'm not going to enter that trade. I mean, I used to when I was a beginner thinking that like just because the pattern broke that means it's going to go to the downside. But trust me, there are time and time again where that may be true where it breaks down to the downside against the trend, but more likely than not, at some point it will turn back around and go back up before hitting your profit target. That's why you just have to ignore those trades that when a trade breaks out against the trend and it doesn't fit your criteria, that even if it does go in the direction that breakout was and that it goes to like a really far profit target, like if this just broke down and went down in a straight line, you would look back and think like how you missed this amazing trade. But that's not true. Just because there was one amazing trade doesn't mean that that's the likelihood or the probability. I can tell you right now that it is far more likely that if this breaks out in the direction of the trend, that we're going to have a way better probability of this getting to our profit target rather than if it broke to the downside against the trend, which is going to have substantially less probability. We're talking maybe like 10 or 20% of it getting down to somewhere down here. And now this leads us to our next question on getting clear, and that is, how can we know if a stock will continue to run in our direction for a long time? Well, I honestly couldn't tell you. The stock market can be extremely random, and there aren't many data points that can accurately depict whether a stock will continue to run because there's no way of knowing what will happen in the future or what will happen when a stock gets to another price level. That's why all we can do is find the criteria that adds to our edge. So to answer the question, when day trading a breakout, I look to make sure there isn't a really strong price level in the way on a larger time frame. And if there is, I may wait until it breaks out through that level before entering. I'll also only day trade the first 2 hours of the market open. That's when I'll have the best chance of finding a stock that will move enough to reach my ambitious profit targets, since most of the stocks tend to dry up throughout the day, have less liquidity, and make it less likely to get to the profit target that we're seeking. So what other criteria could we find that would make a breakout hit a large profit target without hitting a tight stop loss? This is when honing into the market comes into play. Now we can start defining stocks and scenarios that would make a strong breakout more likely, such as a recent news about a stock or earnings or an economic event that moves the entire stock market, such as COVID or interest rate hikes or war with Russia. We can also backtest stock criteria such as the market cap, industry, unusual volume, what percentage of stock is up or down in the pre-market, and any other criteria you can use to identify an edge and increase your accuracy. Now, when we put all this together, you can see that we're exclusively day trading obvious price levels with a breakout gap fill strategy during market open on the 5-minute time frame with stocks that have recent news with unusual volume that open far away from their previous levels and that trade with minimal chop in one clear direction with momentum that don't have any obvious resistance price levels nearby. And we're just getting started on getting clear. This is just the beginning of honing in. The more you get clear on exactly what you're looking for, the more accurate you'll be entering trades that have a great risk to reward ratio and a high likelihood of reaching your ambitious profit target without hitting your nearby stop loss. And the more specific you get, the more accurate you'll be and the easier trading will be because you'll know exactly what to look for and exactly what to expect. And if your trade goes against you, you'll know that it wasn't your fault and that it was just one of those times that the trade doesn't work out, and that's fine because that's that expense that we have to pay to run the business of day trading. So really ask yourself, am I trading one specific strategy or am I trading all sorts of different stocks in different scenarios on different time frames with different strategies? Am I really honed in enough? Can I get even more specific to increase my accuracy? Because finding the answer to these questions can take you from a failing jack of all trades to a specialized, profitable day trading machine. I know it might suck, but if you're still trading without a specific strategy, you've got to stop enjoying the thrill of gambling and start putting in the work to get clear on exactly what you want to trade. You'll have so much more fun day trading when you're making more money with less stress and less effort. I don't want you feeling unhappy and stressed all the time, and I don't want you to blame yourself. So please, 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 do yourself a favor and take the time to step back, zoom out, get clear on your strategy, even stop day trading if you need to, which is very likely, because sometimes you really have to take a step that far back to remove yourself and really get clear on what you want without all of your desires, emotions, and thoughts weighing on your decisions and warping your perspective. It's just like simplifying and automating a business so that it all runs naturally and you're not a gambler, you're a business owner. And you've got this. So until next time, get clear, keep it simple, and take it easy on yourself. What up, my dudes and dudettes? I know that I say this a lot, but I've got some real game changers for you today. And that's because today we're going to find out whether you've done your homework. And that's right, we're going to find out whether you've gotten clear enough to become consistently profitable.